Mrs. Viñes Fiestas, thank you for agreeing to this interview. To briefly introduce you to our audience, you're a commissioner at the Comisión Nacional del Mercado de Valores, which is the Spanish securities regulator, and you're also the chair of the EU Platform on Sustainable Finance. This is the topic that we will discuss today, the present and future of the EU Sustainable Framework. But maybe you can start by telling the audience a bit, what is the EU Platform on Sustainable Finance and what are the main priorities in its agenda?
Thank you very much. It's a pleasure to be with you today. The EU Platform on Sustainable Finance, it's a stakeholder group. It's the advisor to the European Commission when it comes to the development, the implementation and the use of the EU taxonomy and the wider sustainable finance framework. The platform works with a mandate, normally of 2 years. It's a 2 years mandate. And at the very beginning of the mandate, the European Commission tells us, this is your homework, right, for the next 2 years. And that's what, and we deliver during the mandate, and at the end, we deliver the different, tasks that have been commissioned to us. So for this mandate that is about to finish at the end of March, our priorities were 4. The first one was to work on usability. So basically to really look at how could we, make the European taxonomy and the different pieces of the regulation much more consistent between them.
Can you explain the EU taxonomy also?
Yes.
Just briefly.
Briefly. The taxonomy actually only means, scientific classification, yeah? And you need to think about it. I like to think about it as a dictionary that tells you which economic activities can be deemed sustainable and under which circumstances. And it tells you that through technical criteria. So if an economic activity when it's conducted meets that criteria, then it is sustainable. Now, you can also think about the taxonomy as the 21st century, metric system. Why do I say that? Because what it makes very unique, the EU taxonomy, is that, this description of being environmental then is transformed into a common measurement system. How? By requesting companies to report, the percentage of the revenues generated from activities that meet the criteria. And through that revenues, you get a picture of where a company is when it comes to sustainability and the percentage of sustainability of their activities, but also equally on the percentage of their investments that they are aligned with the taxonomy or they are made to make their activities or assets, align with the taxonomy. So it is also forward-looking, Now it goes one step further because it not only asks companies to report on that, but also financial market participants for the financial products. So if a financial product is commercialized as being green or environmentally sustainable, or that has environmental characteristics, it needs to report the percentage of the fund that is aligned with the taxonomy. So basically, it is, a common and consistent measurement tool to measure the sustainability of companies, financial products, financial instruments, and investments.
So, for people to understand, maybe a tool to help prevent greenwashing.
Well, think about food products. Okay. Yeah, you think about food products. Nobody tells any food product how much salt or sugar they need to put in the product, correct? But if I tell you, true. Leopoldo, it's 25 grams of sugar a day, too much? What would you say?
You need a measurement, right?
Right, you have no idea. And this is that's why it was created what is called the daily recommendation intake, right? So in products, you have how much sugar there is, and then you have a reference point, so
You benchmark, as we say.
Benchmark.
That's cool.
That's exactly the same. The taxonomy is the benchmark for sustainability for financial products, financial instruments, and companies' activities.
And coming back to my question then, so this is the underpinning of what you do at the EU Platform on Sustainability.
Because you would understand that, if you commercialize a product as being low fat, the least thing you can ask is to publish how much fat it has, right?
Yeah.
So it's exactly the same.
Okay, fair enough. Now, there's this big backlash about the ESG agenda overall, and probably here I can share you something. When I started my career, and I was a securities regulator like yourself, but starting, and I remember the big fuss at the time was the report from BlackRock that they sent a letter. It was not a report. The CEO
Larry
sent
Flink's
the famous letter, and it seemed like we were all gonna go green.
Yes, when 20 years before, it has already existed, the Institutional Investors Group on Climate Change in Europe, with more than 100 investors that have been working on, engaging with companies for 20 years, but that's okay. Yes,
he was the famous
BlackRock.
one. Yeah, it was BlackRock, that's it. So it kind of, the hype started there, but then now it suddenly stops. And my question to you is, how seriously do you think supervisors, banking supervisors and regulators should consider this backlash and what to do, if anything?
Yeah. But before I answer your question, let me say, if there is a backlash, it's because it's been very successful. It is true. So successful that it has become mainstream. 56% of the European market is ESG. Therefore, it is starting to have a real impact on the ground. And that's why there is a backlash. Yeah, and it's very important to understand. But that to aside, no matter, how much, if we take 1 or 2 or 3 steps backwards, nobody is going to take away, number one, physical risks. Yeah, we just experienced in Spain, the Dana, hugely, from a human perspective, terrible, but also from an economic perspective, it's going to cost more than 10 billion, right? I counted of over 20 billion of losses, but also think about the banks had an exposure in terms of the bank loans, linked to the affected areas of more than 20 billion. So what we're talking about, Los Angeles, more than 130 billion. So let's start, adding up. What we're talking about here, and this is what is so important, it's about financial risks. And what we're talking about is about financial stability. What we know is the physical risks are only going to increase if we slow down action or if we simply, opt for inaction. The second point is around transition risks, very interesting, because if you delay action, you're not going to reduce the transition risk. Some people think that the physical risk, transition risk, are interchangeable, that there's a trade-off. That's wrong, Inaction or delay in action, the only thing it does is increases your physical risk and your transition risks. The European Central Bank and other supervisors have very well talked about the disorderly transition.
Allow me to break it down a bit.
Yes.
Physical and transition risk, we probably need to make that explicit. What do you refer to?
So physical risk is the example I was just saying, It's the impact, and in this case, the financial impact of the consequences of climate change because of the higher frequency, severity of extreme weather events, whether we're talking about floods, fires, droughts, etc., etc. Yes, that as the degree, the Earth, increases the temperature, they increase. Now, transition risks are those risks that they are attached to the cost of transitioning, So from the policies, think about the carbon markets. From putting a price on carbon, it has a cost for a company, right? So that's attached to the transition risk. Now, but if you allow me, and going back, the other thing that no matter how many steps back we take, nobody's going to take away is the absolute need for private capital, to fund the transition. So, And I really like to highlight, and I will do it over and over, that we are in January 2025. We have only 25 years left to reach net zero. Mm-hmm. So it's quite urgent that we act.
It is quite urgent. And now I'm going to take you to a part that's generating a lot of intrigue now. There's a lot of discussion happening right now, probably of an upcoming regulation in Brussels to revamp and simplify the sustainable finance framework, this Omnibus law. Some organizations and activists have raised the point and have seen this as a potential step back in the development of this important task that the EU has been doing. What is your view? How can you inform this debate?
The first thing is very important to understand is that the sustainable finance package was, conceived as an overall strategy that included all the members throughout the financial value chain, and that you need to think about it a little bit like a big jigsaw, where every piece of the regulation is one piece of the jigsaw, right? And the central piece is the taxonomy. However, these different pieces were developed and negotiated separately. So now when we try to put them together, sometimes they're not quite fixed. So there are, very legitimate claims of working on, the need for further consistency and avoiding duplication. The platform Sustainable Finance has been working on that for quite a long time now. By the end of our first mandate in October 2022, we published a report on data and usability that made 64 recommendations to the European Commission on how to enhance the consistency of the framework. The other point that is also very legitimate is to say, well, now we have a couple of years when it comes to the taxonomy of real experience. This is experience on the ground from the largest companies in Europe, public traded companies in Europe, implementing and reporting on the taxonomy, and the first year of proper reporting from financial institutions. We have collected, over the last 2 years, we have collected a lot of evidence. We have reached out to all different types of stakeholders, the seven to be precise, types of stakeholders, and we have accumulated a whole series of, evidence and technical things that needs to be changed in order to improve, to help simplify and improve the taxonomy, which if taken into account, will make it much, much more effective. Now, after saying that and understanding that there are legitimate calls for simplification and consistency, I want to highlight two things. The first one is that it's just very normal, given the novel nature of the taxonomy and of the framework, and the very fact that this is the first time ever, in history that something like that is put in place, that there are things that do not work on the ground and need to be revised. It's also very legitimate to ask for closer collaboration with the industry, to have a faster feedback of what works, what doesn't work. Having said that, the taxonomy is working on the ground. We have in 2 years, of reporting, more than 480 billion have been invested in taxonomy-aligned activities or in becoming taxonomy-aligned. The majority of those investments we're talking about in the energy sector, real estate, industry. And that is what it is, that purpose of the taxonomy, which is to mobilize capital towards sustainable investments. We're also seeing more and more sell-side studies from the sell side that are proving that there's a correlation between taxonomy alignment and financial market performance, right? Which it is the purpose, because at the end of the day, the whole purpose is to help companies access the finance they need to transition.
Mm-hmm. Great. Well, thank you very much for this conversation, and thanks for these insightful views.
You're more than welcome. It's been a pleasure.